The Roth versus traditional question has a hidden third option that wealthy families use to minimize their lifetime tax bill, and most people never consider it. I've discovered that the smartest strategy isn't using one type over the other. It's strategically using both as part of a tax diversification system that gives you an incredible amount of control in retirement. We'll cover the 4 critical factors that actually matter, why having both types of accounts might be your best strategy, and the tax diversification approach that sophisticated investors use. I'm Bob Wolf, certified financial planner and IRS enrolled agent. I've spent nearly a decade working with high net worth professionals and families at national wealth management firms, helping them optimize multi-million-dollar portfolios. Before we go any further, important disclaimer here, this strategy is educational content and should not be interpreted as specific financial or investment advice. So here's the thing about this whole debate. Everyone's giving you the wrong framework for making this decision. Let me start with an analogy that'll make this crystal clear. Imagine you're at a restaurant and the server gives you 2 payment options. You can either pay for your meal up front at today's menu prices, or you can eat now and pay whatever the prices are when you're ready to leave, which could be hours later. That's essentially what we're talking about with the Roth versus traditional accounts. With a Roth account, you're paying your tax bill today, you contribute after-tax dollars, your money grows completely tax-free, and every withdrawal in retirement comes out without owing Uncle Sam a penny. You know exactly what your meal costs up front. With a traditional account, you're deferring the tax bill. You get a deduction now, your investments grow tax deferred, but you'll pay ordinary tax on every dollar you withdraw in retirement. You're betting that the menu prices or your tax rates will be more favorable later. Now, most people hear this and think, obviously I'd rather pay taxes now and enjoy tax-free withdrawals forever. But that's where it gets dangerous because that thinking is based on fundamentally flawed math. So let me show you what I mean with real numbers. Let's say you have $10,000 to invest for retirement. If you put it in a traditional account, you get a tax deduction now. The full $10,000 gets invested and hypothetically it grows to $20,000 over time or double. When you withdraw in retirement at a 25% tax rate, so to speak, you pay $5,000 in taxes, leaving you with $15,000 to spend. Now let's take the Roth scenario. You pay 25% in taxes up front, so you only have $7,500 to actually invest. Same logic here, the money doubles to $15,000 when you withdraw and pay 0 taxes on it. You have $15,000 to spend. The spendable amount is identical. So the real question isn't when do you want to pay taxes, it's when will your effective tax rate be lower? And that's where this decision gets really interesting. So factor number 1, your tax rate trajectory, and this is the big one. Your choice should be based on whether you expect your marginal tax rate to be higher or lower in retirement compared to today. Your retirement tax rate isn't just about future law changes. It's about your total income picture. So let me give you a real example from my practice. I had a client earning $500,000 roughly annually who was religiously contributing to a Roth 401k. He was paying taxes at nearly 35% on those contributions. But when we mapped out his retirement spending needs, he'd need about $80,000 annually, putting him in about the 12 to 15% tax bracket range. So by strategically switching to traditional contributions, he was essentially arbitraging a 35% tax rate today for a 12 to 15% rate in retirement. That's a massive difference that compounds over decades. When we ran the numbers, this switch would save him about $180,000 in retirement. Now conversely, if you're early in your career in the 10 or 12% bracket but expect to have substantial retirement income from multiple sources, retirement contributions make total sense. You're locking in historically low tax rates. And here's something a lot of people aren't considering right now. We are in a historically low tax rate environment. If you look at a chart and graph over what tax rates have looked like both from a capital gain and an ordinary income perspective over hundreds of years of United States data, we are at the lowest points that we've seen across the board. Factor number 2, your career stage and your earnings trajectory. If you're early in your career or currently in a lower tax bracket, Roth contributions are generally a smart play. If you're in your peak earning years, especially if you're in a 32% bracket or higher, traditional contributions are making more sense for us to consider. You're getting a substantial tax relief now when you need it most, and you'll likely be in a lower tax bracket when you're not earning your W-2 income. For those in those middle brackets, 22%, 24%, it becomes more of a judgment call. If you expect significant income growth, lean more towards Roth. If you're approaching retirement, lean more towards traditional. Another piece here is considering which state we may end up retiring in and what that state income tax looks like relative to our current state. If we're on the fence and we're living in a high state income tax regime, but we're considering moving to Florida, New Hampshire, or any of these states that has a lower or zero tax system, this is another feather or point towards going towards contributing to a traditional account, kicking the tax can down the line so that then we can withdraw from a zero tax state environment. Factor number 3, the tax diversification strategy. This is where I differ from a lot of different professionals, and it's honestly the approach that wealthy families have been using for years. You should probably have both types of accounts. Think of this as tax diversification. Just like you wouldn't put all of your investments in a single stock, you shouldn't put all of your retirement savings in a single tax structure. Having both traditional and Roth accounts gives you incredible flexibility in retirement. You can strategically withdraw from either account depending on your tax situation each year or the tax rate environment and how it changes historically, essentially controlling your tax bracket. Here's how this works in practice. You might take enough from your traditional accounts to fill up your lower tax brackets, let's say up to the top of the 12% tax bracket, and then take any additional money that you need from a Roth account tax-free. This strategy and understanding this simple concept can dramatically reduce your lifetime tax bill. I had a client couple who built this exact setup. In retirement, they take about $80,000 from their traditional accounts, keeping them in the 12% tax bracket, then pull another $40,000 from their Roth accounts completely tax-free. Their effective tax rate on $120,000 of spending is only about 8%. This approach also hedges against future tax law changes. Nobody knows what tax rates will be in 20, 30 years. How a lot of things have happened within even just the last 5 years that we would be lying to ourselves if we can predict out that far. So having options gives us flexibility regardless of what happens politically. Factor number 4, the contribution limit arbitrage. Roth accounts effectively allow you to save more for retirement. Let me explain this. If you contribute $23,500 to a traditional 401k, you're not really saving $23,500 for retirement. Some of that money belongs to the IRS. You're just deferring when they collect it. If you contribute $23,500 to a Roth 401k, all of that money is truly yours. Plus, you've already paid the taxes on the contribution from other funds, meaning you've collectively contributed more to your retirement when you consider the total cash outflow. So for high earners who have the flexibility, can max out their contributions either way, the Roth option effectively allows you to put more money towards your retirement on an after-tax, tax advantage basis. This is especially powerful if you're in the peak earning phase and have cash flow that can handle a higher tax bill today. There's another layer here that affects this strategy, the difference between 401ks and IRAs, because this creates some interesting opportunities. 401ks are employer-sponsored plans with higher contribution limits regardless of income, $23,500 for 2025 plus $7,500 if you're 50 or older. Many employers offer matching, which is essentially free money regardless of which type you choose. IRAs have lower contribution limits, $7,000 in 2025 plus another $1,000 if you're 50 or older, but typically offer more investment options and flexibility. For traditional accounts, 401ks have no income limits for tax deductions, while traditional IRAs have income limits if you're covered by a workplace plan. For Roth accounts, Roth 401ks have no income limits, while Roth IRAs do have the income limits that prevent high earners from contributing directly. This creates opportunities for sophisticated strategies. High income earners who can't contribute directly to a Roth IRA might choose to use the backdoor Roth strategy, something that I help clients all the time and also go back and fix when they did it wrong. Let me show you what the most tax efficient retirement setup looks like. This is the framework I help my clients build, and it's what wealthy families have been doing for years. The optimal strategy involves having multiple buckets of money with different tax treatments. Bucket number one is your traditional accounts. This allows you to fill up the lower tax brackets from withdrawals. For a married couple in 2025, you can have up to $96,950 in taxable income and still stay within that 12% bracket. Bucket number two is your non-retirement brokerage accounts. These are for long-term capital gains, which are taxed at preferential rates, often 0, 15, or 20%, depending on your income. Bucket number three is your Roth accounts for tax-free withdrawals above your other income sources, allowing you to maintain spending power without pushing you into higher tax brackets. This three-bucket approach gives you an incredible amount of control over your tax situation in retirement. You can withdraw strategically from each bucket to optimize your effective tax rate each year and increase your after-tax return. It's like having a tax style that you can just adjust based off of your needs and the yearly circumstances. Before we wrap up, let me address some persistent myths that just keep circulating because I see these costing people money. Myth number one, Roth accounts grow tax-free, so they're always better. The reality here is that if your tax rate is higher now than in retirement, you're essentially overpaying. Paying 32% in taxes today when you can withdraw at 22% in retirement means you're leaving 10% of money on the table. Myth number two, tax rates will definitely go up, so Roth is safer. The reality here is that while tax rates may increase over time, especially with given where our national deficit is to be bridging that gap, your personal tax rate in retirement might still be lower than during your peak earning years because you'll likely have less taxable income. Myth number three, if everything stays the same, Roth is better. The reality here is that, as I showed you earlier, if tax rates stay exactly the same, the math works out identically for both account types. So what's the bottom line? The answer to the Roth versus traditional question depends on four critical factors. Number one, your current tax bracket versus your expected retirement tax bracket. Number two, your career stage and your earnings trajectory. Number three, whether you're maxing out your contributions and have the ability to do more. Number four, your desire for tax diversification and flexibility with the other accounts that you have and resources in mind. For most people, the optimal approach involves having both types of accounts. This gives you options in retirement and hedges against future uncertainty. Here's my general framework. If you're early in your career or in a low tax bracket, 10 to 12%, lean heavily towards Roth. If you're in your peak earning years or a high tax bracket, 32% or more, lean towards traditional. If you're in those middle brackets, 22 to 24%, consider splitting your contributions. Regardless of your situation, consider building toward that three-bucket retirement tax structure that's more balanced so that you have more flexibility come time to fund your retirement. Remember, the goal isn't to avoid taxes completely. The goal is to pay the least amount of tax over your lifetime while maintaining flexibility to adapt to changing circumstances. This is complex stuff, and everyone's situation is unique. What I've shared today is an educational framework to help you think more strategically about your retirement planning. For personalized guidance that considers your specific situation, goals, and the full complexity of tax law, work with a qualified advisor who understands advanced tax planning. If this breakdown helped clarify the real factors behind this decision, hit that like button and subscribe for more strategic financial insights. And if you want to dive deeper into building a comprehensive retirement strategy, check out some resources in the description. Thanks for watching, and I'll see you in the next video.